Thank you to AGI for inviting me to give this AGI seminar today. Before presenting my paper, I would like to spend a few minutes talking about the International Association for Research in Income and Wealth, IARIW. Since one of the purposes of this seminar is to celebrate my inauguration as president of this association. As Dr. Penn mentioned, I became president of this association in August of last year, and my term is for 2 years. And I want to talk a little bit about this association. But before I talk about the association, I need to talk about the Committee for Research on Income and Wealth, CRIW. This committee was founded in 1936 by the Nobel Prize laureate Simon Kuznets, and it was founded in the United States. And it has been administered by the National Bureau of Economic Research, NBER, the foremost economics research institution in the US, if not the world. And the purpose of this committee was to advance the cause of measurement in economics and to bring together economists from government, academia, business, and nonprofit organizations to discuss problems of mutual interest relating to measurement. The problem is that the scope of this committee was primarily limited to the United States. And Professor Kuznets felt that there was a need for a similar organization with a worldwide scope. Therefore, in 1947, he founded the International Association for Research on Income and Wealth, IARIW, together with Richard Stone of the United Kingdom. And as Dr. Penn mentioned, both of the founders of this association are Nobel Prize laureates, and I don't know of any other economic association that was founded by 2 Nobel Prize winners. And so the first president was Simon Kuznets, and the second president was Richard Stone. And after that, there have been a total of 39 presidents during the 78-year history of the association, including such distinguished economists as Irving Kravitz and Alan Heston, who together with Robert Summers created the Penn World Tables, a widely used database on national accounts data for a large number of countries across the world. And I'm the 39th president and the first person from Asia to become president. And my term will be for 2 years. In terms of the purpose of the IARIW, the association is devoted to economic measurement, as in the case of the Committee on Research in Income and Wealth that I talked about earlier. And it's unique in bringing together those who create economic data, such as economists in national statistical agencies, and those who use economic data, such as academic economists, and providing an opportunity for these 2 groups of people who create data and people who use data, to interact and collaborate with one another on issues of mutual interest. And the association is most interested in national accounts data, especially during the early years, but it is also interested in almost any other kind of data used by economists, including data on tangible assets, productivity, the informal economy, time use, well-being, poverty, inequality, et cetera, et cetera. And the association has an official journal called the Review of Income and Wealth, which was founded in 1951. And it's one of the most highly ranked scholarly journals in economics with an impact factor of 1.9. And its aim is to advance knowledge on the definition, measurement, and interpretation of national income, wealth, and distribution. And as a journal with an international leadership, preference is given to studies of methodological interest and comparative analyses of more than one country. So actually, the paper I'm presenting today, Why Do Europeans Save? It was accepted by the Review of Income and Wealth 2 days ago. So this paper has already been accepted for publication. And also, so one function of the association is to publish this journal. Another function of the association is to hold conferences. The association holds a general conference in even-numbered years and 2 special conferences on more narrowly defined topics in odd-numbered years. And conferences are held throughout the world, and there is always a local host, most often the National Statistics Office or the central bank of the host country. And since 2025 is an odd-numbered year, two special conferences will be held this year. The first on population aging, implications for economic measurement and economic performance, was held in March in Tokyo 2 months ago under the joint sponsorship of the association, Shotsubachi University, the Economic and Social Research Institute of the Cabinet Office, and Daitaku University. The main organizer of the conference was Professor Chihiro Shimizu of Shotsubachi University, who has been a longtime member of the association. And the second special conference of 2025 is improving well-being measurement in data-challenged environments in developing countries for better evidence-based policies. This special conference will be held in Hanoi, in Vietnam, in October. And I'm looking forward to going because it will be my first time going to Vietnam. But anyway, I'm very happy that both of the special conferences that will be held during my tenure as president will be held in Asian countries, including one in Japan. The next general conference will be held in Brussels, Belgium in August 2026, with the local host being the National Bank of Belgium, which is the central bank of Belgium. And we're planning to hold special conferences in Uzbekistan and the United States in 2027, and the 2028 general conference in Warsaw, Poland. So you can see that we hold the conferences all over the world. So my final message about the association is please become a member. And it's very reasonable, only $40 a year for a membership fee. And please attend the IARIW conferences, the special conferences, as well as the general conferences.
40, not 400.
$40, so maybe like 6,000 yen a year. So it's a real bargain. And please present your papers at the IARIW conferences, and please submit your papers to the review of income and wealth. Okay, so that's my little introduction to the association. Now I want to talk about my own paper. So the topic that I will be presenting is why do Europeans save? Micro evidence from the Household Finance and Consumption Survey. This is a joint paper with Professor Luigi Ventura of Sapienza University of Rome in Italy, and it's the third joint paper that we presented, that we've written together. Okay, and so there are four research questions that we try to answer in this paper. The first question is, why do people save? In other words, for what motives do people save? The second research question is, which saving motives are the most important? The third research question is, what determines the importance of saving for each motive? And the fourth research question is the selfish life cycle model or the altruism model more applicable in the real world? In other words, are people selfish or altruistic? Oh, by the way, please feel free to interrupt me at any time if you have any questions or comments. So just talking for 1 or 2 minutes about theoretical considerations, the selfish life cycle model assumes that households save only for their own needs, such as saving for retirement and saving for precautionary purposes. By contrast, the altruism model assumes that households save not only for their own needs, but also in order to give intergenerational transfers, such as bequests, inter-divorce transfers, and assistance with education and marriage expenses to their children. Also, in some cases, assistance with housing purchase. So looking at the motives for which households save will shed light on which model applies in the real world. In other words, whether households are selfish or altruistic. So let me give you a brief survey of the literature, and because of the time limitations, I will only talk about my own papers. Although, of course, many other people have written papers about saving motives. So the two papers that are most closely related to the paper I'm presenting today are the two papers shown on this slide. The first paper with Wako Watanabe of Keio University is Why Do People Save? A Micro-Analysis of Motives for Household Saving in Japan. This paper was published in Economic Journal in 1997. And another paper with three co-authors. The title of the papers are Americans More Altruistic Than Japanese, a US-Japan comparison of saving and bequest motives. This paper was published in the International Economic Journal, a Korean journal, in 2000. And these two studies find that life cycle motives for saving, such as the retirement and precautionary motives, are the dominant motives for saving in both Japan and the United States, and that saving for altruistic motives are far less important than saving for life cycle motives in both countries. And the current study does a similar analysis for the European countries, but goes beyond these studies by shedding light on the determinants of the importance of saving for each motive. So actually, my doctoral dissertation that I presented to Harvard University in 1985 was also about saving motives. And in my doctoral dissertation, I looked at the case of savings for education, saving for marriage, and saving for housing purchase. So I have had a strong interest in saving motives throughout my research career. But I look mostly at the case of Japan and the United States, and this is the first time that I have looked at the case of European countries. I'm sorry, I'm presenting a paper about Europe, even though this is the Asian Growth Research Institute. But I think there are some lessons that we can learn from the case of Europe. So let me next talk about the data source that we use in this paper. As the title of the paper, the subtitle of the paper indicates, we use data from the Household Finance and Consumption Survey, HFCS. This is a longitudinal panel survey of about 91,000 respondents in 19 Euro area countries, plus Croatia, Hungary, and Poland. The first wave of the survey was conducted in 2010, 2011, the second wave in 2013, 2015, the third wave in 2017, and the fourth wave in 2022. So we use data from waves 2, 3, and 4, especially wave 3, the baseline results of wave 3, which was conducted in 2017. And there are a number of other surveys of the European countries, such as SHARE, survey of aging and retirement. But this survey, this survey is, well, I didn't mention on the slide, but this survey is conducted by the European Central Bank. And this is a very well-known survey. It's a very good survey with many extensive questions about household finance and consumption. And there's another very good survey, SHARE, which is also for a large number of European countries. But for this, and I wrote another paper with Luigi Ventura using the data from the SHARE survey. And we looked at the saving behavior of elderly households in Europe. But in this paper, we used data from this European Central Bank survey to look at saving motives. And then here I list the countries that are included in our sample. And then I talk about the sample selection criteria, but I think I'll skip this section because of the time limitations. Yes.
Just I want to confirm. So only Netherlands, Poland, and then Slovakia, like those countries that have like 4 waves, and the rest of the country only have like single waves. Is that correct in the data source that you released?
Let's see. For most of the countries, we have information on all 3 waves. But for Croatia and Lithuania, we have information, they were not included in wave 2. So we only have information on waves 3 and 4. In the case of Ireland and Malta, for some reason, they were included in wave 2, but then they were dropped. So we don't have data for waves 3 and 4.
But most of them have like complete waves, right?
That's right. Yeah. I'm sorry, that's not clear. Yeah. So the countries that don't say anything, they have information on all of the waves. So before you get bored, let me show you some of the results that we obtained in our analysis. So first, I want to present data on the proportion of households saving for each motive based on the full sample and based on the third wave that was conducted in 2017. And this shows the percent of households saving for each motive. And households were allowed to circle as many, well, first of all, there were 11 motives that were given in the questionnaire, and households were asked to circle as many motives as were applicable in their case. So there was no limit on the number of motives that they circled. And that's why the numbers will not add up to 100, because most households circled more than one motive. So the most important motive was the precautionary motive. 62.5% of households were saving for this motive. The second most important motive was the retirement motive, with 48% of respondents saving for this motive. Travel, holidays, so basically leisure-related saving, 26%. Inter vivos transfers, 25%. Saving for the purchase of consumer durables such as automobiles, electrical appliances, and furniture, 18.6%. Bequests, 12.7%. Housing purchase, 9.7%. Then there are a few other motives that were not that important at all. So you can see that there are some motives that are consistent with the life cycle motive, such as precautionary motive, retirement motive, that are very important, and also some motives relating to intergenerational transfers, sort of altruistic motives, such as inter vivos transfers and bequests. They are also important to some extent, but in general, it seems that motives that are related, selfish motives that are related to the life cycle model are more important than motives relating to the altruistic model or to intergenerational transfers. But are these motives the most important quantitative? Just because a large proportion of respondents are saving for a given motive does not mean that this motive is quantitatively important. We also need to take account of the amount of saving for each motive. For example, 62% of households are saving for the precautionary motive, but the amount of money for precautionary saving may be very low, meaning that this motive is not very important. Whereas the bequest motive, only 12.7% of households are saving for this motive, but the amount of saving they're doing for bequest may be very important. So we also need information on the amount of saving for each motive. And so we turn to that next part of the analysis. So the survey does not ask people, the survey asks people how much saving they're doing or how much wealth they are holding. But the survey does not ask people how much of your saving or how much of your wealth is for retirement, how much of it is for precautionary purposes, how much of it is for bequest. We don't ask people the amount of saving they're doing for each bequest, for each motive. So we have to use some kind of a regression analysis to estimate the amount of saving for each motive. So what we do is we take the logarithm of the wealth to income ratio, the ratio of the household's financial net worth to annual income, as the dependent variable. And the main explanatory variables we include are dummy variables for each of the 11 saving motives. And then we include a number of control variables, respondents' age, the square of the respondent's age in case age has a nonlinear impact on, say, wealth income ratio, the respondent's educational attainment, gender, marital status, household size, homeownership, and country dummies. Or country fixed specs. And the estimation equation is very simple. The dependent variable, as I said, is the log of the wealth income ratio. We include the 11 saving motive dummies and a number of other control variables. And in terms of how to interpret the results, the coefficients of the saving motive dummies, A1, A2, A3, so forth, can be interpreted as the percentage amount by which the wealth to income ratio increases when one saves for the motives in question. So, for example, A1 measures the percentage amount by which the wealth income ratio increases when the household is saving for motive 1. So these coefficients can be regarded as measuring the quantitative importance of each motive for household saving. The importance of each motive for household saving. So this table shows the results from the regressions, and I put the coefficients in percentage terms. So for example, people who are saving for the purchase of financial assets, their wealth income ratio is 61.7% higher than people who are not saving for that motive. People who are saving for retirement, their wealth income ratio is 42% higher than people who are not saving for retirement. So you can see that the ranking of the motives is very different. Previously, we found that the precautionary motive is the most important motive when if we classify motives by the proportion of people saving for each motive. But if we look at the impact of saving motives on the wealth to income ratio, the precautionary motive ranks number 9. It's one of the least important motives. But the retirement motive is important regardless of which criterion we use. So we found that 49% of respondents are saving for retirement. So the proportion of respondents saving for retirement is very high. But the amount of saving for retirement is also very high. People are saving for retirement motive. Their wealth income ratio is 42% higher than everyone else. So for some motives, their ranking is roughly the same, regardless of which criterion we use. For other motives, their ranking is very different depending on which criterion we use. And the most important motive in this table, purchase of financial assets, this is not really an ultimate use of the money. People are saving in order to buy, for example, equities or some kind of financial assets, but ultimately they're planning to use that money for something else, to buy a house or to finance retirement and so on. So it's just not really a saving motive that reflects the ultimate use of the money. So if we exclude that motive, the retirement motive is the most important motive. Bequests are also relatively important. People are saving for bequests. Their wealth income ratio is 35% higher than other people. Inter-vivos transfers are also somewhat important, but the precautionary saving motive is not very important in terms of the amount of saving. But this measure is also not an adequate measure of the importance of saving motives because it does not take account of the proportion of households saving for each motive, which we presented in the first table. So the most comprehensive measure of the importance of saving for each motive that takes account of both the proportion of households saving for each motive and also the amount of saving being done for each motive by households saving for that motive is the share of saving for each motive in total household financial net worth. So let me explain that in a little bit more detail. So how do we calculate the share of saving for each motive in total household financial wealth? So this equation here, SI is the share of saving for motive I in total financial net worth. PI is the proportion of households saving for saving motive I, and BI is the coefficient of the dummy variable for saving I in the financial net worth to income ratio regression. And as I argued earlier, BI can be regarded as a proxy for the share of financial net worth for saving motive I in total financial net worth for housing saving for that motive. So basically, we can calculate the share of household saving for each saving motive by using this equation and using information on the proportion of households saving for each saving motive, together with information on the quantitative importance of each motive as proxied by these coefficients from the regression analysis. So the numerator is the proportion of household saving for motive I times the coefficient of motive I in the regression, and the denominator is the sum of these products for all motives. So it's basically scaling the results so that they sum to 100. And this is our most important table. This table shows the share of saving for each motive in total household net worth. So this is the most comprehensive measure of the importance of saving for each motive. For example, for the retirement motive, its share of total financial net worth is 50.3%, roughly one half. So one half of people's financial net worth is for retirement purposes. 11% is for bequests, 9% for inter vivos transfers, 8% for precautionary motive, and so on. So the most important motive by far is the retirement motive, which is of course the most exemplary saving motive according to the life cycle model. But we also find that saving for bequests and inter vivos transfers, which are consistent with the altruism model, the saving for these motives are also somewhat important. If we combine the two, we get roughly 20%. So 1/5 of total financial net worth is for intergenerational transfers. Precautionary motive is also somewhat important, but not as important as implied by the figure for the proportion of people saving for the precautionary savings. Okay, so this is the key result that we obtained for the full sample for the wave number 3 conducted in 2017. And we also do a number of robustness checks, but maybe we will, I won't talk about them in great detail, but just to tell you briefly, the results I just presented pertain to wave 3 conducted in 2017, but we replicated analysis for wave 2 conducted in 2014 and wave 4 conducted in 2021, and the results were broadly consistent, except for the fact that the share of retirement saving was considerably higher in 2021 than it was in earlier years. So for some reason, saving for retirement seems to be increasing in importance over time. Maybe because the populations are aging, they're getting closer to retirement. And maybe also because there have been, reforms of the social security system leading to reductions in pension benefits. And then we also did a number of robustness checks using a different wealth concept. In the baseline regressions, we used financial net worth, which is defined as financial assets minus liabilities. But we also replicated our analysis for total net worth. So we included real assets, such as land and housing. The results were broadly consistent, with the retirement motive being of dominant importance, followed by the inter vivos transfers, housing purchase, and bequest motives. So it didn't really matter which wealth concept we used. Then we also did a number of heterogeneity analyses. For example, we replicated our analysis for 3 age groups: younger workers, defined as people 44 or younger, older workers 45 to 64, and retirees 65 or older. And we found that, as you might expect, saving for retirement and bequests increase with age, because as you get close to retirement or as you get close to death, we might start placing more emphasis on saving for retirement or saving for bequests. By contrast, we found that saving for housing purchase and saving for the purchase of consumer durables, that their shares decline with age. People typically buy houses or buy consumer durables when they're relatively young. And these motives may become less applicable as people get older. And finally, we found the share of some motives do not show any clear trends over time. So that was what we found in terms of the impact of age. We found that there are some differences as well as some similarities by age group. And another heterogeneity analysis we did was to look at the impact of wealth. We divided the sample into 2 groups: low wealth groups, with those whose financial net worth is below the median, and those whose financial wealth net worth is above the median. And we found that the retirement motive is the dominant motive stated in both wealth classes. And we found that the shares of the retirement, bequest, and inter vivos transfers motives are lower, and that the shares of the precautionary and consumer durables motives are higher in the low wealth class. So in other words, low wealth people tend to save more for precautionary and consumer durables motives and save less for retirement, bequest, and inter vivos transfers. And that makes sense to me because, someone who is less affluent, they may not be able to afford to leave bequests and inter-people's transfers to their children as much as wealthier households. They may also not be able to afford to save as much for retirement because they have more urgent saving needs. And finally, we looked at the impact of social protection policies. So far, we have looked at which saving motives are most important. But now we wanted to shed some light on the determinants of the importance of saving motive. What determines how important a given saving motive is? So we looked at the impact of public pensions and the impact of public health expenditures. So in terms of our analysis of the impact of public pensions, we divided the countries in our sample into countries that have relatively generous public pension systems and countries that have less generous public pension systems. And as a criterion, we used the gross pension replacement rate. So the proportion of pension benefits to pre-retirement income. If that replacement rate is higher than the OECD mean, we classify the country as a generous public pension country. If the replacement rate is below the mean, we classify the country as a less generous public pension country.
We include East European countries as well.
Yes, we include East European.
Variety of countries.
Right, yes, yes. And in terms of the results, we found that the proportion of households who are saving for retirement is slightly lower in the high pension countries as you would expect, but the difference was not that great. But we found that the quantitative importance of saving for retirement, in other words, the share of saving for retirement in total wealth was much lower in high pension countries, meaning that the share of saving for retirement in these high pension countries is about 10 percentage points lower than in the full sample of countries. In other words, in the high pension countries, proportion of people saving for retirement is slightly less. The amount of saving they do for retirement is much lower. And as a result, the share of retirement saving in total wealth is quite a bit lower than in the low pension. So this supports the hypothesis that the generosity of public pensions affects the amount of saving people do for retirement. If the country has generous public pension systems, people are less likely to be saving for retirement. People are less likely to be saving for retirement. People are likely to be saving less, a smaller amount for retirement, as a result of which the share of retirement in their total wealth is less than in other countries. This is as you would expect, because if you expect to receive generous public pension benefits, you will not feel as great a need to save for in preparation for retirement. And we obtained similar results for public health spending as well. So we divided countries into generous national health systems and countries with less generous national health systems. And what we used as the criterion is that we used OECD data on public spending on health as a share of total health spending. And if the share of public spending on health was higher than the mean, we classified the country as having a generous national health system. If the share of public spending on health was less than the mean, we classified the country as having a less generous national health system. And we found that in countries with more generous public health systems, the proportion of households who are saving for precautionary purposes is slightly lower, and that the quantitative importance of saving for precautionary purposes is much lower than in other countries, meaning that the share of precautionary saving in such countries is much smaller than in the full sample of countries. So again, we find evidence that generosity of social safety nets has a profound impact on household saving behavior. If the country has a generous public health system, then people will save less likely to save for precautionary purposes. They will save less for precautionary purposes, as a result of which the share of precautionary saving total wealth will be lower than in other countries. So I think this is fairly persuasive evidence that the generosity of public of social safety nets, such as public pensions and public health systems, greatly influences people's saving motives. And one final thing that we tried was to look at change in wealth regressions. In the baseline regressions, the dependent variable was the wealth to income ratio, which is a stock concept of saving, how much people hold at a given point in time. But we also tried using the accumulation rate of financial assets, sort of a flow concept of saving as a dependent variable. In particular, we used the accumulation rate of financial assets between wave 2 and wave 3, between 2014 and 2017 as our dependent variable. And if we look at the results for these change in wealth regressions, the results are broadly consistent with our results for the stock of wealth regressions. We find that the retirement motive is still the dominant motive for saving, although its relative importance is lower. And more generally, the shares of saving motives with longer time horizons, such as the retirement and bequest motives, are smaller in the case of the change in wealth regressions. And the shares of saving motives with shorter term horizons, such as the precautionary and travel holidays motives, are larger. In fact, the coefficient of the precautionary motive is statistically significant, unlike in the case of stock regressions. I didn't talk about this in detail, but in the stock regressions, the coefficient of the precautionary motive was not statistically significant. But in the change in wealth regressions, the coefficient of the precautionary motive does become significant. And I think this is partly because the shares of saving motives with shorter term horizons become more important in the change in wealth regressions. So again, this is another type of robustness check to show that the dependent variable that we use does not really matter, whether we use a stock concept of wealth or whether we use a flow concept of saving. The results are broadly similar, except that saving motives with a shorter term horizon become more important to use a flow of saving concept of a dependent variable. So those are the basic results that we obtained. So let me summarize and discuss the policy implications. So in this paper, we analyzed the saving motives of European households using microdata from the Household Finance and Consumption Survey, which is conducted by the European Central Bank. We found that the rank order of motives differs depending on what criterion is used to rank them, whether you use the proportion of respondents saving for each motive, the quantitative importance of saving for each motive, or the share of saving for each motive in total household wealth. And our finding that we found that the saving precautionary motive is the most important motive. The saving motives are ranked by the proportion of households saving for each motive. We found that the retirement motive is essentially the most important motive. The saving motives are ranked by the amount of saving being done for each motive by household saving for that motive. And we found that the retirement motive is also the most important motive if saving motives are ranked by the share of saving for each motive in total household wealth, which is the most comprehensive measure of the importance of saving motives. Moreover, the generosity of social safety nets seems to affect the importance of each saving motive, with saving for the retirement motive being less important in countries with generous public pensions, and saving for the precautionary motive being less important in countries with generous national health systems. And these findings suggest that the saving for the retirement motive and saving for the precautionary motive are the dominant motives for saving in Europe, partly because social safety nets are not fully adequate. Now, finding that both saving motives that are consistent with the selfish life cycle model and saving motives that are consistent with the autism model are important in Europe implies that the two models coexist in Europe, as in the case of other parts of the world. However, our finding that the retirement motive, which is the saving motive that exemplifies the selfish life cycle model, is of dominant importance in Europe, strongly suggests that this model is far more applicable in Europe than the altruism model. We find that saving for intergenerational transfers, inter-vivos transfers can be less, is only of secondary importance with a combined share of about 20%. So this finding provides further corroboration that the selfish life cycle model is much more applicable than the altruism model in Europe. And I didn't prepare a slide, but if we compare the results for Europe with my earlier results for Japan and the United States, in all three countries or regions, we find that the retirement motive is the dominant motive for saving. And of course, it's a motive that most exemplifies the selfish life cycle model. And in all three countries or regions, we find that saving for intergenerational transfers, which are consistent with the altruism model, are of some importance, but not of dominant importance. And we find the saving for retirement in Europe is roughly in between Japan and the United States. Retirement saving is less important than it is in Japan, but more important than it is in the United States. Turning to the policy implications of our findings, our finding that saving for the retirement and caution motives is so important in Europe, and our finding that the generosity of social safety nets reduces the need for saving for these motives implies that expanding social safety nets, such as public pensions and public health insurance, would be an effective way of reducing the need for saving for these motives and improving household welfare. Then a second policy implication is that our finding that saving for intergenerational transfers, in other words, for bequests and inter-vivos transfers, is of some importance, implies that wealth disparities are passed on from generation to generation to some extent, implying that governments should perhaps raise state gift or wealth taxes to weaken this tendency. I was talking about this with Dr. Hatta over lunch today, but I think I agree with him in terms of the need to raise estate and gift taxes in order to alleviate the tendency of wealth disparities to be passed on from generation to generation. So thank you very much for your attention.